everyone. Welcome to the Midweek with Indiacharts. This is Shilpa and we have Jay with us. Hi Jay, how are you doing?
I'm fine. How are you?
I am doing very well. So, Jay, there has been, internationally, there's been a lot of chaos, and we are really excited to know how it has affected the market, and also what are your views. And I'm also, personally very interested to know what is the new things that's introduced on Strike, and how about we learn more about the Strike platform. So, I would like to ask you my first question quickly, Jay. The US 10-year yield has hit 5% recent, and there the US equity market has corrected significantly in the past few days, right? So what's happening there, Jay? Please let us know.
So yeah, I mean, there has been a lot that is happening in the equity market. And firstly, we are sorry that, in the past 2 or 3 weeks, we couldn't do midweek because we were more or less working on strikes and, we were trying to bring new updates. But, recently we have, we went live with the fundamental module. And very soon, that is today or probably by tomorrow, even the derivative module will be live.
Okay.
So more or less, that is done. So hopefully we should now be able to do the midweek regularly as well. So yes, coming back to your question, a lot has happened in this past 2 3 weeks, and the equity markets have corrected. The US 10-year yield, that has hit a 5% mark, and that has led to some chaos and some panic in the market. So broadly, wait, let me share my screen.
Yes, please.
So yes, so broadly, if we see for the US 10-year, okay, more or less, we had mentioned this earlier as well, that it is basically in a fifth wave on the upside, okay, and at some point of time, it is likely to cool off, okay, but as long as it doesn't cool off, we have to basically wait for the reversal, because as you see over here, the yield is taking support at the 20-day average and it is continuing to rise higher. Okay, so until and unless we don't see this trend fizzling out, okay, and we don't see the 10-year breaking below the 20-day average and sustaining below that, until then, we can see some sort of momentum continuing on the upside. So that is basically on the bond yield. But what is happening is that, there have been few important things that are happening in the US market. So firstly, when we look at the S&P 500 and we look at the weekly chart, okay, let me also share the Bollinger Band. Yeah. So if we see over here, basically this trend line is broken in S&P 500 index, okay, and we have seen a weekly close below that. Now this is not just S&P 500, but many of the other US indices are also breaking down. So then if we see the Dow Jones Transportation Index, that has given a breakdown from the support line. And in fact, now what is happening is that this entire rise has become a corrective rise. And what do we mean by corrective rise is that this is just a counter trend rally. If this is a counter trend rally, then what it means is that the prior correction was the actual trend. This bounce was a counter trend rally, and now the prior trend which was down, that can possibly resume. Okay, so this is on the Dow Jones Transportation Index. Now if we look at the Russell Index, which is US Small Cap 2000, so over here as well, see what had happened was that in Dow Jones Transportation, take it Nasdaq, S&P 500, everywhere we saw a retracement more than 61.8%. Okay, but in the Russell Index, what happened was that there was a decline and then there was a sideways sort of consolidation. Now we were hoping that this sideways consolidation may end up becoming some sort of base triangle. Okay, and after this triangular structure, eventually the pattern will break on the upside. Okay, that was the initial expectation. But now that this triangular structure has broken on the downside, so now the things can get ugly, because this entire decline can be one wave of decline, okay, which will mark it as W. in Elliott wave, we basically call the corrective structure. I mean, whenever the complex correction happens, we label it as WX, YX, Z. So this entire decline was one leg, after which we saw a corrective structure in a triangular pattern, which was wave X. And now this triangular pattern is breaking on the downside. So effectively, what we are going to see is wave Y, which means that we are likely to see the equality level of that. Okay, and which means that there could be an meaningful correction that can possibly come by in the days to come. And effectively, what is happening is that when we look at the relative strength amongst the indices, okay, so Russell is actually the weakest, which is the small cap. Okay, then followed by Dow Jones, transportation, those all are weak. Then S&P 500, that is also weakening, and Nasdaq so far is strong. Okay, but given that all of the other indices are weakening, there is a good chance that even Nasdaq eventually gives up. So this actually pattern is kind of a little scary. Okay, and what it is telling us that there is a lot of risk that exists in the US market right now, and until that doesn't subside, we have to be careful and we have to be on the sidelines.
Okay, that's great. So Jay, what we have seen is in the weekend, our founder and strategist, Mr. Rohit Srivastava, had released a long short-term report emphasizing a change of stance and the possible scenarios for the Nifty index. Yeah. So can you share some key insights from the report and what's the outlook on mid and the small cap index, Jay?
Yes. So Rohit sir had actually written a quite a heck of a report, and in which he had covered everything. So all the people who want to see this report and the subscribers, basically they can go to the long short report, and there was this report that was released on the weekend, which is flipping on a dime, and you can see this entire report over here. Okay. So one of the very important thing which is also related to US is actually this chart. Okay. What it tells you that it is a yield curve inversion. Now, few months back, I think once when the yield curve had actually inverted, okay, that was the time we had mentioned it in one of our midweek. I don't remember, but it was, I think, somewhere in the month of December or Jan. Okay, so what happens is that a yield curve, I mean, it will be a negative yield curve when the shorter term bonds, uska yield actually goes above the longer term bond ka yield. Now, typically what happens is that there is a lot of risk that is involved in the higher tenure, right, than the lower tenure. So typically higher tenure demands more yield than the lower term, right? So in this case, now what has happened is that the lower term yields are actually demanding more. I mean, the lower term bonds are actually demanding more yield than the longer term. And this is actually an abnormal situation. Okay. And this is happening because the Fed has tightened way too fast. Okay. So now what is happening is that this yield curve, which had gone to -100, okay, wherein the differential has gone to -100, now it is normalizing. Okay, and in the past we have seen that once it normalizes, okay, and the 2 and the 10 year actually becomes a positive curve, so that's where typically we see the recession hitting as well. Because see, earlier the expectation was that the CPI is cooling off, so the Fed governor will basically back off from hiking the rates, and at some point of time they will even start cutting rates. But that has not happened. The Fed has clearly stated that it is likely to keep the rates higher for longer. Now, how long does it keep? That needs to be seen, because such high rates will eventually break something. Because I think I was reading somewhere the mortgage rate right now in the US is somewhere around 8.3%. In India, it is 8.5%, 9% or so. Okay, I mean, you haven't seen that US ka mortgage and India ka mortgage at the same level. So that tells you that over there is a lot of pain that is there, which is yet to be realized. Okay, so once that happens, there is likely to be a slowdown over there. and you call it slowdown, recession, but what will happen is that there will be a cooling off in growth, and that can also lead to a correction. Now in the past we have seen that once this yield curve normalizes, okay, we have seen a bigger correction, and typically that has led to some sort of black swan event. Okay, now what black swan event this time we can get, it is need to be seen. But if we don't get any black swan event, then at least what may happen is that we might end up seeing a correction, and post that correction, that's where a new cycle will begin, and this corrective phase we are in, that may end, and probably a new up move could unfold. But this chart is actually very important, because this chart has a strike rate of 100%, because in the past 4 or 5 instances this has happened, and each time it has led to a correction in the market, and those correction has been significant as well. Okay, so that is something that we need to really take care of, and this is one of the most important risks that we are seeing right now in the US indices, because like I said, that many of the US indices are breaking down. Now given this backdrop, okay, what is happening in the Indian market is that, see, when I look at the Nifty 50 index, so this is something I want the listeners to understand, because see, over here what had happened was that when the US indices fell almost around 25 to 30%, okay, our index fell just 12, 15% or so, somewhere around that. So it was, this was something that was very different from the past. That is because in the past, if US used to fall 20%, we used to fall actually 20-30%. Okay, this time's outperformance in the Indian index has been very crazy, and that is something that we have not seen in the past. Now, can this be a change of a longer term trend, given that the growth prospect which India has? So that is why, this time what we are doing is that we are going level by level. Okay, what do we mean level by level is that, firstly we were watching very closely the 20-week average. Now this week, most likely the 20-week average is going to break. Okay, if the 20-week average is going to break, and if we see the number of legs, which we have mentioned in the past as well, that this is 1, 2, 3, 4, 5, 6, 7, 8, and 9. So once an impulse is complete, so impulse is usually 5 plus 4 plus 4 and so on. Okay, so over here right now 9 legs are complete. Okay, which means that this entire move is complete. Now a retracement of this move is likely to come in the near term. So in the very near term, the downside level which we are watching out for is nothing but the 40-week average, which is somewhere around 18,900 or so. If that breaks, okay, then the retracement of the entire move will actually come into play. Okay, wherein we can probably see a retracement up to the 50% or the 61.8% mark. If it is a 61.8% mark, it comes to around, I think, 18,115 or so. Now that is quite a meaningful correction, and things can get worse if this 61.8% breaks. Now, like I said, we don't know how exactly this correction is going to unfold in the US indices. And like I said, that whenever the yield curve normalizes after going from the negative territory, usually some sort of black swan event has happened. Okay, so that is where again, why I'm being a little careful over here is that we don't know to the extent what can go wrong. Okay, if it is a routine correction, probably we may see Nifty index not breaking the 61.8% retracement mark of the rise which we have seen from the bottom. Okay, but if the 61.8% breaks on a closing basis and the Nifty sustains below that, then things can get ugly. Okay, so that is why right now we are keeping all the options open at this point of time, and given that we are seeing a risk in the market right now, so that's why what we are doing is that we are taking a step back and we are looking at the structure and we are waiting for things to settle down. if we see the things settling down, if we see the US markets also, completing its corrective phase and all, then that's where, we'll again be interested, because there is no doubt in our mind that, 3 years, 5 years down the line, the markets will be much, much, much higher than the current levels. Okay. But in the near term, we have a lot of risk, in the US markets and across the globe. Okay. This war is happening. No one knows how long this war may, go on, how ugly it can get. Right. So there are a lot of uncertainties at this point of time. So that's why we are taking a step back and we are seeing everything level by level. So like I mentioned, 40-week average, which is somewhere around 18,900 or so, that will be the level that we watch out for. If that is broken, then 50% and 61.8% retracement mark will come into play. And if 61.8% mark is broken, that's where, we have to be really careful and we have to be watchful as to what is happening. Okay. So that was on the Nifty index. Now, when we look at the Nifty midcap index, okay, over here, what has happened is that, see, when we look at the daily chart, okay, you can see clearly that from this high to this high, okay, this blue line, which is the 40-day exponential average, that was not breaking. In fact, even this golden line, that was also not breaking as well. Okay, that was the 20-day average. Once 20-day average broken, that's where the structure weakened. And once the 40-day exponential eventually broke, that's where it led to a massive sort of correction over here. Now, the thing is that if the entire rise which we have seen from the bottom, that is from year to year, and if that is complete, okay, then there can be a meaningful correction, or it could be a big sort of, time-wise correction that we can see in the days to come. Okay. And that's where we need to be again very careful, because right now, if we see the weekly chart, it is exactly at the 20-week average, which it has tested today. But if the 20-week average breaks, this week, then there can be a correction that we can see in the days to come. Okay. So again, over here, there is a meaningful risk. And if we see the Nifty small cap index, so if we see the Nifty small cap index, that's where, again, we are seeing this blue line, which is the 40-day exponential breaking. And again, this can be a threat. And, we can see a meaningful correction, or probably a long time-wise sort of correction in the days to come. And we have seen how, rotation is happening in the market. So it can happen that the small cap index may not move higher or may not go down much, but internally a lot of stocks get affected. Okay. This is something that we have seen in 2018-19 as well, where the indices were not doing anything, but the stocks were getting, beaten like left, right, and center. So that things can happen. So basically, there is a lot of risk that is involved at this point of time. And we have seen a runaway rally in this past 3 to 6 months. Okay. So that is where, it is time to protect our capital and stay back. And once this risk subsides, that's where, we could actually, preserve the whatever cash we are preserving right now. That is what we can again deploy to maximize our return. Okay. So that is what I think, one should probably be doing. And that is what, we have highlighted in the report as well. Now, just as a disclaimer, we are not an advisor and we don't advise. Okay. In this long short report as well, we have given all our observations, what we feel. Okay. And all the risk factors that we see at this point of time, so that people can take informed decision. Okay. And that is how we are, positioning ourselves, that, we are trying to step back, and we are seeing and we are monitoring all the levels very closely. And as in when we get some confirmation, we will keep you updated.
Okay, that's great. So Jay, what are the sentiment indicators on strike telling us right now?
Yeah. So in this, again, it is very important to understand which are short-term indicators and which are the indicators that affect us from a medium-term perspective. Okay, when you see the swing reading, like we have said earlier as well, that it is a very short-term indicator, and you can see that there is a positive divergence over here, and we saw a bounce, which we saw in Nifty. And now again, after this correction, it is getting back to the oversold zone. But it is very important to understand the market trend, because if the market is down, the swing will consistently be at the lower levels. It may form divergence, and then we may see a pullback in the Nifty index, and that's where again the swing will go up. Okay, so right now what swing is telling us that maybe in the near term we are reaching that oversold zone. So there can be a chance that there can be a pullback and then a decline. And in that case, what happens is that we see a divergence in the swing, and only then we see a meaningful bounce in the Nifty index. Okay, so swing can also help you to manage your risk, and to know that at what point you should be aggressively into the trend. I mean, how should you position aggressively into that trend? And once, if you see the swing reading is coming to the lower levels and you are short, then you will be more cautious and you will be keeping tighter stop loss, because chances of a pullback is high. Okay, but now the other thing is that when you look at the diffusion indicator, okay, and within that, actually when you look at the moving averages, so now you can clearly see that almost only 20% of the stocks are above their 20-day average. Okay, that tells you that there is some weakness in the market right now. Okay, when we look at the 50-day, again the same thing, only 30 stocks are above the 50-day average. If you see 100 SMA, okay, only for 52% of the stocks are above the above the 100-day simple moving average. So as you can see, what is happening is that the Nifty went higher over here, but the number of stocks being above the 100-day average or the 20-day or the 50-day kept falling. And that is telling you that this up move which we had seen in the Nifty index, that was on the back of much lesser participation from the stock. Okay, so that was telling you that the momentum on the upside is losing. Now what is happening is that when we look at the 200 SMA as well, okay, wait, let me remove the drawing. So yeah, when we look at the 200 SMA, that is still at a very high level. Okay, and now once we see the 20-week Nifty breaking, which already it might end up breaking because it is somewhere around 19,300, 19,400 or so. Okay, if that happens, then weakness will start creeping in the Nifty index, and that's where you're seeing this percentage of stock about 200 at 72, that may even decline further. Okay, and which means that internally a lot of stocks can take beating. So in this case, basically what you have to do is that you can run simple scanners. Like if I see over here, if I go and if I scan for the stocks basically which are below the 20-day average or so, or 20-week average. So say over here I say below, in the time frame I do weekly, and over here I say 20-week. So now the stocks which are below the 20-week average, and especially which are in the FNO basket, those are actually the weakest one. And that is where probably you can also find your setups if your studies are telling that it can go down. But again, you can use scanners, you can use heat map. We have already indicated in the past how to use the heat map. You can go there, you can check the relative strength. Okay, and typically in the market what happens is that strong gets stronger, weak gets weaker. Okay, so over here your idea would be to focus on the stocks which are weaker. Okay, and when your setups gives a sort of a sell signal, that's where you can probably go ahead and you can take the trade. But the good part is that all these scanners will help you to narrow down your focus list, so that you don't have to spend time just to find out the stock. It will be simply that you put your parameters, you get the list, and then you can concentrate on those stocks. So once again, for the people who are not aware about the scanners, you can use the technical scanners. You can also use our Rohit momentum indicator, which is our proprietary indicator. So over here as well, these signals throw up basically buy, sell, new buy, new sell, which means new buy and new sell are basically new crossovers that are happening. So again, you can filter over here and you can see which are the stocks you probably want to concentrate. Similarly, there is something called as Dow trend, which is nothing but higher high, higher low concept. Higher high, higher low, lower high, lower low. Okay, so over here, the moment you see a signal which tells you that it is up to down, it means that the prior trend was up, and because now the low is broken, the trend is turning down. So this can again be a part of your filter process, and these all things can help you narrow down your focus list and focus on the stocks which are weak, so that you have more time to execute your trade, rather than just going and finding out the stocks and going through all 180 stocks and seeing all the chart, and which can be a very time consuming process. So you can, with the help of Strike, you can do that, and you can quickly understand which are the stocks that are weak, which are the stocks that are strong.
Wonderful, Jay. That was very well explained. Thank you so much. So what we can define is Strike is pretty amazing as a platform. And today we came to know more intricately how it saves our time, how we can easily find out what are the strong stocks, what are the weak stocks, what is going to work for you. And if you keep following us and really understand what Jay explains us every week, you are going to ace the game of stock market. Thank you so much, Jay, for giving us your time. And as usual, we are going to leave our web.strike.money link. Okay, go sign up for a free trial. This is your chance to have a free trial for Strike. And also, while you are at, I'll also give you the link of our Strike's YouTube channel. Go and follow us there, because we put daily updates, what we are introducing on the platform, what are the developments to it. You can get to a more closer outlook to it. Yeah. And also follow Indiacharts YouTube channel and click on the bell notification, because every time you get a notification, every time we upload a video, you get a notification. Thank you so much for your time, guys. Thank you so much for your time, Jay. Take care of yourself. Yeah. Thank you.